Nothing. Nothing but. Nothing but net.
Welcome to Nothing But Net, the podcast for triple net commercial real estate investing. Before we get into the meat of today's show, let's recap on why there's so much interest and buzz around net properties. Triple net properties are commercial real estate investments where the tenants, usually brand name corporations, pay you rent every month. Can you say mailbox money? In addition, they pay the real estate taxes, insurance, and maintenance for the property. No toilets, termites, or taxes. What's not to like? You can remember what net or triple net stands for by using TIM, taxes, insurance, and maintenance. With triple net properties, there's lower risk income and cash flow because rents are guaranteed by strong credit tenants. Preservation of wealth, because rent increases and property appreciation are bulwarks against inflation and a great store of value. Tax efficiency. The government wants investment in commercial real estate, so they provide inducements through depreciation and deductions which shelter income from taxation. Tax deferral, which gives potential for infinite tax deferral with 1031 exchanges, which are very popular in the triple net space. Triple net properties are a tangible asset, and as Mark Twain once said, buy land. They ain't making any more of it. Hello and welcome back to the Nothing But Net podcast, the podcast for triple net commercial real estate investing. I'm your host, Adam Carswell, joined by our co-host, Michael Flight, and we have another special episode coming up for you guys here today with an industrial real estate focus. We have two industry professionals joining us here with really just amazing backgrounds to begin with. So we're going to get into the bios here. Actually, before we get into their bios, though, I do want to hand it over to Michael. Michael, fresh off the plane from Dubai, how are you feeling and what are you looking forward to in today's conversation?
I am excited to be on the call with these two guys because these two guys not only have a fantastic biography and backstory, they're also doing real estate that we don't really do too much, which is industrial real estate. So I'm looking forward to learning some stuff from these guys.
Absolutely. And I actually know what I think back to the time I lived in California for a 6-month span in my life. And during that time, got to meet Matt face to face, thanks to Michael, thanks to the connection you made there. So pretty warm conversation we're stepping into here today, guys. A little bit about Matt Shamus. He's the co-founder of Driven Capital Partners, also known as DCP, a diversified real estate private equity firm with a portfolio totaling 11 projects and approximately $100 million in value. Matt started DCP to invest his own capital in high-quality commercial real estate in U.S. growth markets. And Matt has enjoyed a successful entrepreneurial career spanning the finance, real estate, and technology industries, including 6 years at Facebook. Dan Kennedy has actively invested in real estate since 2011, focusing on well-located investments with strong cash flow in markets from California to Texas. In 2017, Dan began divesting his single-family residence portfolio to a focus in commercial real estate acquisitions. Dan started investing in syndications, allowing him to further diversify his holdings in Class A student housing developments in downtown Los Angeles. At DCP, Dan's focus is on asset management and investor relations. He manages the portfolio of assets meticulously, optimizing each property's potential while implementing the business plan that was put in place upon acquisition. Lastly, cool thing about Dan here, as we mentioned, Matt has the Facebook background. Dan has the professional soccer background, spent 12 years of his career and played most recently for the LA Galaxy. Dan was selected by his peers to represent the Major League Soccer players as an executive board member for the Players Association. In this role, he was responsible for collective bargaining agreement negotiations, strategic planning, executive team building, and a budget approval. Quite the introduction for both. As I mentioned, cool to have a Facebook guy and an MLS guy here on the call talking industrial real estate. That's enough out of me. Michael, do you want to dish it over to Matt and Dan now?
Yeah, I'm just going to say it's intimidating to be around both of these guys and actually how young they are and what they've done. It's even more intimidating because Dan is a professional broadcaster, so he's going to make us look bad. So I'll hand it over to you. Matt, do you want to start us off?
Sure. Well, thanks for having us. And I better get going here because as soon as I let go of this microphone, I don't know if I'm ever going to get it back. Yeah, looking forward to talking with you guys about what we're doing specifically with industrial triple net properties and kind of our approach and strategy and what we look for in deals. And I'm so happy to take the conversation really wherever you guys want.
Fantastic. Dan, why don't you just tell us a little bit about, everybody talks to you about the sports side of it. You, with your education part of it, really have an interesting story that you're trying to explain to professional athletes how they can actually get, as you said, passive income later on in life. And you're trying to get them out of the ordinary stuff and into what we like to say is great, steady, tangible assets of real estate.
Well, Adam, thanks for the intro. And Michael, thanks for having us on. You talk about intimidation. I mean, we're here to learn. That's how we started this relationship with you guys. We felt like you guys could teach us something. Appreciate you guys having us on. It must be noted, I played for 12 years, but I was not very good, right? So like I was a journeyman. I wasn't the guy that was going to make millions of dollars playing the sport. And I wasn't the guy that was going to be able to ride off into the sunset and retire and never have to work again. And in fact, for the first half of my career, I probably thought that I was closer to the end than anything else. I really didn't, from year to year, I didn't know if I was going to be playing the following season. So when I started making a buck, the only thing that I felt comfortable investing in was real estate. And it was because it was something where you could drive down a street, understand the neighborhood, see a house that was the most rundown on the block, buy it for under market, and put a little bit of money in it and lease it and cash flow. And that was the start of my investing career. And that was 2011. Matt and I, though we have different backgrounds, Matt and I have been hanging out for the last 14 years, and our wives are best friends. Matt grew up with my wife, and we, as our career paths started to take shape and we started to earn a little bit, it was at the same time. So we shared this ambition and the notes of like, okay, how are we going to grow our wealth, and how are we going to scale our ability to earn outside of our jobs? And real estate was the vehicle. For athletes, there's a couple key points, and this is not the reason why athletics is such a great metaphor is because it's applicable to real life. I mean, if you want to be a successful real estate investor, a successful athlete, a successful teacher, it's about consistency. And it's not about, oh, I want to get New Year's coming up, it is around the corner, I want to go get fit. I'm going to go work out really hard one time and I'm going to be fit. It's the same thing with investing. You're not going to invest one time and get rich. So what the business Matt and I have set up is to create a diverse offering for people to look at and say, hey, you know what? In 2021, Driven Capital Partners is going to have 8 to 10 deals that they're going to put in front of me. And I'm going to be able to invest in all of them or none of them, because we're going to go do the deal with or without any one of our investors. That's the value we're creating. And then we take care of the asset, we acquire it, we sign on the debt. And for the investor, it's completely passive. And the education piece to the investor is that we're the professionals. We're going to do this better than you can do it. The majority of our investors have other jobs. They have kids, they have lives. Their week is full as it is, right? And so this value we're creating on the real estate side is huge. And then for their portfolios and for their life, the value creation and the affordability that it's going to give them in 10 years, if they are consistent, right? If they are really going down a road of strategy of like, this is what I'm going to do with my life. For athletes with a 10-year career, you can make a lot of money, but if you don't invest it, when your career is over, you're not going to have anything to show. And so what I'm telling the soccer guys or the golf or baseball or hockey guys that we talk with is it's always about, well, let's think about 5-8 years down the road here. You don't know if you're still going to be playing. If you are, great. But if you're not, if you could have $100,000 a year to fall back on, now you don't have to work. You can go find the job that you want. And so we're trying to unlock people's lives in the next 5 to 10 years here. And it's all going to be dependent upon how ambitious they are with their own investment strategy. That's what gets me excited to really go to work every day.
And I think you hit on the biggest thing. The takeaway is like, even Matt has the same problem. And I think what the United States does is like they route everybody into college and then they route everybody into getting a job. And they don't ever teach anybody how to accumulate wealth. I've always been interested in real estate from, when I was in college, because it just was always more entrepreneurial. It's like the one thing that everybody falls back on. I was just at this family office conference, and everybody loves real estate, because it's a way to preserve, protect wealth, and it's a way to create passive income. And I know it sounds like a, late night TV commercial, but it's like your money is working for you while you're sleeping because the tenants are paying rent. And so that's what we really like about the commercial net lease stuff, and what you guys are going to talk to us about, a different part of the commercial net lease stuff, because you've got really solid companies paying the rent. So you've got a little bit higher extra guarantee versus, as you know, it's sometimes hit and miss with the tenants in the houses and the apartments.
I think what would be fun today too is definitely get into some real life examples. And Michael, you being the 30 plus year experience expert here, what are some questions for examples we could ask these guys now that we got them here today?
Well, why don't you guys tell us a little bit about, some of your industrial deals, and actually why you decided to go, triple net, because I know you guys have done, multifamily and single family houses and things in the past. So what got you interested in doing the triple net, and what got you interested in doing the industrial?
Yeah, I can I can take that. I think like starting out anything new, I think a lot of people's approach tends to be go spread a broad net, go wide, and don't go so deep. Try get a lot of repetitions at different things and see what feels appropriate and feels right. So I think that's what we kind of both did early on in our real estate investing careers. So we've done lots of different kinds of deals. We've done single family homes. We've done duplexes, triplexes, small multifamily. We own some medical office properties. We own quite a few multifamily properties. And more recently, really in 2019, we started thinking a bit more about what is a more scalable approach to growing this business and achieving strong risk-adjusted returns, but not looking for the home run on every single deal, really looking for something a little safer, a little bit more consistent, and a little bit more stable. So in 2019,
I need to interrupt you because I'm smiling right now. When you say safer, stable, and sorry to interrupt you. Go on.
Well, so our approach right now with our portfolio is Dan and I invest our own money in every single deal that we do, and we started this business to do that. Our approach is we look at deal by deal, but we have a kind of a portfolio strategy. We don't want to own all the same asset class in the same geography. We want to be diversified across the country and across different asset classes. And what we've honed in on, especially since COVID, is in this moment, we value stability and we value lower risk profiles than we did even a year or two ago. That kind of has led us to looking at opportunities that we feel like are lower risk. Right now, we have 4 triple net industrial deals in our portfolio. We have another under contract and a couple more behind that for early 2021. And what we are doing is kind of balancing a portfolio with this stable, consistent, high cash flowing, high yielding triple net deals. To us, a little higher risk profile deals like heavy value add multifamily in markets with really low cap rates. So those deals just inherently have greater risk. They have the potential for a really high return as well, but they're not stable. They're not consistent at all. So we're kind of balancing these higher risk investments with a more stable kind of consistent return profile for more capital to go to work in that way.
So you guys are creating a balanced mutual fund with real estate. And so some of your value add stuff is like your growth stocks. The triple net part is your fixed income side of it. So you know that you're going to get the stable cash flow from the triple net side. You know that you're going to get the doubles, triples, and hopefully the home runs with some of the value add.
Yeah, that's a good analogy. And so right now, just with all of the uncertainty in the world, we have, of course, consistent tension with China. We have the social unrest in the country and the backdrop of COVID and any other number of factors lead to, in my mind, just this environment where I place a premium on lower risk. We still have to go put capital to work. We're not going to sit on the sidelines, but we're being very cautious in our approach. For triple net deals, what we look for industrial triple net deals, what we look for are generally, we want the story to be tenant has been in the property for quite a while. They've shown a commitment to the property in the form typically of investing a significant amount in their space. Their rent as a proportion of their gross revenue generated at the location is very low. The lower, the better. The business is required to physically be in the space in order for the business to run. You can't have a large proportion of people working from home. We really want, so these are things like manufacturing, assembly, production, and typically the properties that we buy will have a large industrial component and then a smaller office component. Okay. Oftentimes we look for a headquarters. So you have top management of the company located on the premises, and that's where they do their manufacturing and assembly. I'm sorry, I interrupted you.
No, I interrupted you, and I do apologize. We should probably back up because there's a number of different, shall we say, food groups or segments of the industrial space. So there's logistics, there's actual physical manufacturing plants. As you said, there's light assembly. There's also last mile distribution. One of the hotter areas right now with COVID has been the cold storage, refrigerated stuff. They even group in the data warehouses and data centers in industrial buildings too. So what type of things do you guys like to buy?
So we're opportunistic. We want to understand the market and the story and the competitive advantage of the particular company that is occupying the space. Largely what we've gravitated towards is light manufacturing, kind of production, assembly style businesses. We don't own any logistics or last mile distribution centers, for instance. We've looked at many. We haven't pulled the trigger on any yet, but we're opportunistic.
That's good. That's good. Now, I'm going to bring us down a sidetrack and a rabbit hole. One of the issues, especially with heavy industrial, you could also get into it with light industrial, is environmental concerns. So whenever you do a property, you're always doing some thorough environmental investigation. Is that correct?
Yeah, we try and do as much as we can. Of course, you're always going to get an environmental, a phase one environmental study. And if there's anything to look at past a phase one, you go into a phase two. We have killed a number of deals because of environmental issues that we weren't comfortable with. And those deals often involved a heavier manufacturing process, whereby at some point in the past, some kind of material was likely dumped on the property. And now you have an issue that you can certainly overcome some of those, but they can be quite challenging at times too. So we have a low risk tolerance for environmental issues.
Yeah, I always say that in anything that would be typical construction or cleanup, if you just put the word environmental in front of it, or you put the word remediation in front of it, immediately puts on 2 to 3 zeros for the price tag. So
yeah. Yeah, trying to get the seller to understand and acknowledge that is a different story. So we look for, I want to finish your kind of answering your question about what we look for. We like businesses that have been in the location for a long time. We love when the rent they're paying is below market. We love when we can acquire the building at below and significantly below replacement cost. We like just kind of strong, but a little bit under the radar submarkets. So we're generally not going to be in a core or central location in a particular MSA. But we are going to be in an A location for the product type and for the type of business. And we like leases that, this is kind of where you potentially get into the opportunity in industrial triple net deals to add value even before you close. There's a risk continuum. The lower the lease term, there's potentially risk because you have a tenant that could vacate, but there's also opportunity because if your tenant is 20% below market on their rents and you only have 2 years left on the term, in 2 years, you're going to have an opportunity for a big pop. On the other hand, you could potentially get into contract, in fact, as we are on a property now, and you could, while in contract, assuming the seller is comfortable with it, negotiate an extension with the tenant. And when you acquire the property, instead of having 2 years remaining on the lease, maybe you have 8 years remaining on the lease. You've bought yourself some certainty in the form of a future income stream. You've also reduced risk. You probably have also reduced your potential upside as well. So there's a little bit of a game to be played in these kinds of transactions that, to my knowledge and to my experience, you just can't do on many other property types. So that's a fun little wrinkle that we try to exploit whenever we can.
Yeah, and another thing is some of these are in the middle of downtown areas or just off downtown areas. And, sometimes they just happen to be in the path of growth for the next hot residential area or the next hot area. If you've got like a 2 to a 4 year lease, it could actually end up being like a covered land play. And then either doing the redevelopment yourself, or better yet, you sell it to a developer for more than you paid for it. And, they end up doing the redevelopment.
You just explained a particular project that we ended up killing because of an environmental issue. And we spent almost a year trying to resolve this and get this thing closed. But it just, at the end of the day, we just weren't comfortable taking on the environmental risk.
Everybody says, blah, 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 environmental risk. Back in the 1970s and 1980s, when they created the Superfund stuff, once you got into the Superfund, it was unlimited liability for everything that was involved with that property. So they would just go through everything, and whoever had any type of money, they just tip them upside down and shake the money out of their pockets. So it unfortunately just ended up making a ton of money for attorneys litigating it. At some point, it looks great, but it's better to walk away and say, I'm glad I didn't do that.
Yeah.
One thing that Matt said that really caught my attention, and I haven't really heard this on any other podcast or anything right now, which is a priority on lower risk. And Michael, you were like, I'm happy that you said that. I think there's so many people out there right now, from what I can see, that are still trying to look for the opportunities and the deals that were showing the same returns that we were seeing before COVID, or at least something close to it. Kind of share with us your message on why you've shifted this way. Because again, I haven't heard many people talking about focusing on the lower risk right now. And then I don't know, maybe Dan could also chime in on this one too.
I'll jump in. I mean, think about, we've been working over the last couple of years on value add apartments. We've seen this upward trend in rents across the United States, and COVID happens, and you have now collection issues. You have the inability to get tenants out if they're not paying. And then the underwriting question of where are rents going over the next 18 months? Because if we're buying a value add apartment complex right now, we're thinking about this in 18 months or 2 years time. I mean, that's what it's going to take to turn it around. So it gets really tricky to say, well, okay, if our return profile minimum is a 15 IRR on this value add apartment deal, cap rates have compressed. Freddie and Fannie are saying that they have to hold back reserves on the side to cover themselves in order to do the loan. You're now underwriting to rents that are they proven in the marketplace? Okay. If they are they going to maintain over the next 18 months? So that's a variability we're dealing with on a daily basis when we're looking at asset classes outside of this industrial warehouse realm. And we love apartments, and we're going to continue to do apartments and invest in them in markets that we believe in. And when we're purchasing properties that are grossly mismanaged and under market in terms of value. But that being said, I mean, we're either going to outperform or underperform our projections. It's hard to believe that every single OM we send out, we're projecting a 15 IRR, boom, we hit that 15 IRR right on the head. The reality is we won't do a deal unless we think we can outperform. With that being said, when we kind of peel the onion on what's going on around the world, these deals that Matt was just referring to seem a lot more obtainable in terms of all of the moving pieces that are going to go into anything else that we're going to do with the gross, just based on gross income to rent. And I mean, one of the companies we are underwriting, their rent was like 3% of their gross income. Think about that. I mean, they may have to scale back employees. They may have to scale back production. They may have to adjust their assembly lines. but are they going to have a problem paying rent? It's hard to believe. And in this case, in the property that I'm talking about, the lease was actually guaranteed by the parent company as well. So now you have another layer of insurance there. If there was really ever an issue at the property, you have a guaranteed lease. To pound the drum of, we are really cautious right now. With that mindset, we're taking what we think is what the world is giving us, what the commercial real estate world is giving us, and how we can just limit risk really for our investors and for ourselves. Because we understood when we started Driven Capital Partners 3 years ago that we were late cycle investing. We understood that. And we were very cautious because of it. And we had countless conversations with Michael regarding investment opportunities based on where we were at and thinking about during recessions, what asset classes have historically performed well. You fall back on mobile home parks, apartments, and industrial warehouse space. So we're not chasing speculation. We're chasing what we think is consistent returns.
Well, and you hit on a number of things that I'd like to just keep pounding the nail into the board. Number one, other places where you could get return, municipal bonds, there's absolutely no return. And the risk on those things, to me, are just insanely scary with the pension funds. You can't get any returns in sovereign debt. And then let's go on to the next thing. So let's go to bonds. You end up with really nothing at the end of the bond, even if you hold the bond for the entire duration. And then the really great thing that you were talking to me about was the 3% of rent to sales or rent to gross revenue. That's just completely dynamite. Plus, they might have to lay off people, but it's much harder to lose their facility. So right. The very last thing that they're going to stop paying is their rent, because if they don't have a place to operate, it is probably game over, lights out type of thing.
Yeah, and I mean, we've even seen energy bills higher than the rent sometimes,
right?
And the deals we've underwritten.
Right.
Now, with that being said, I mean, the one thing, how we are trying to differentiate ourselves as operators is how we're picking the tenant. Because in the end, if we love the submarket and we believe in all of these data points that Matt brought up of below replacement costs, under market rents, okay, fundamentally it feels like this is an opportunity to buy. And then once we clear all the hurdles at the property level, then the focus quickly shifts towards the tenant, who they are, what they're doing, the type of business they're running, how diversified their income streams are within that business. Is COVID going to jam them up, or can they maybe be opportunistic here? And so one of the buildings we purchased in Boise had a tenant that we just fell in love with. They're working in irrigation systems and technology, and they're solving a massive problem for commercial properties on how you can save money on your water bill. And it's also a green company. Like, they are solving a variety of problems, and this company has the potential just to continue to move up the spectrum, even in an economy that is declining, because their product, though it is expensive, over time only saves the customer money. So right. When we start to hear those types of stories, so now you think about the downside. Okay, that building under market rent, yes, great submarket, Boise, Idaho. If you're in commercial real estate, you understand that this market is blossoming, thriving.
It's on fire. In fact,
it's
on fire to the point that we can't find anything else to buy.
Right.
It's because of all you California guys moving out there.
Right. You're not wrong.
Yeah. And so now we go and we think about, well, what's the worst case scenario? Well, the worst case scenario is that rents drop and now we're back at market. So then it's like, well, okay, well, if the worst case scenario plays out, do we think this company can survive here? And we do. And so that's just kind of, it's not a perfect science. And clearly there's a lot of due diligence that has to happen in order for us to get comfortable with something. But it's just a little bit of a lens into how we're thinking.
Yeah, let me just follow up on one thing Dan said. A couple things. Number one, we spend the majority of our time in acquisition mode trying to understand and mitigate risk. It's really true. I mean, that's where we spend a lot of time. I just feel like if we can mitigate, if we can understand the risk and quantify it and put in place whatever we can to mitigate it, and we're comfortable with the scenarios, the downside scenarios, that's it. That's all we need to know. The rest of it kind of takes care of itself. If you can be comfortable with the worst case scenario and kind of probability weight certain outcomes. So that we spend a lot of time on that during kind of underwriting and when we're in acquisition mode. But Adam, back to your original question, this is a low interest rate environment, right? We're going to be in a low interest rate environment for a while. And Michael, you kind of touched on some of the opportunities to place money. Interest rates are extremely low. That to me is going to inflate asset prices. Look what's happened in the stock market since April. And on a historical price to earnings, basis, stock market looks kind of overvalued. So to me, that's an indication that in a low interest rate environment, investors are going to have essentially two choices. One choice is we're going to chase the same returns we were used to in years previous, but we're going to take on greater risk to do that. The other choice is we're going to lower our return expectations, and we're subsequently going to lower our risk as well. And so it's kind of like, what are you comfortable with? And for us, looking at industrial triple net deals, it's the latter. We're lowering our return expectations. We're creating a more consistent, stable return. And we're comfortable with that, especially in this environment.
And I just want to pick up on something that both you and Dan hit on, which is what most people don't understand. In commercial real estate, you actually have to know a little bit about what the tenant does. So in commercial, I have learned so much about other businesses through doing commercial real estate, because you need to know how the tenant operates. You need to know how the tenant makes money, and you need to know, what's going to make them successful. You're not only picking the location of the real estate, but you're also like doing the stock analysis and seeing what the growth prospects are for this company.
We spend a lot of time on that. It could be the most beautiful asset in the world, and the lease could be rock solid. And if we don't feel comfortable about the tenant and their business and the industry they're in and their revenue stream, we just can't do the deal.
And that's really the key things that we've hit on with triple net, especially triple net single tenant deals, is that there's location, then there's also the credit underwriting. And so you have to make sure that the location is absolutely premium and right, but just as much and just as important is the credit underwriting, or some of the other things that you went into, which we'll call brand. So in our industry, it's like, do they have a brand name? Are they attracting people to it? With the irrigation thing, that's like a brand story, and that's a growth story. Really, just you guys are like hitting home runs today.
We're trying to hit home runs in about 5 years with these investments.
One thing that I've heard you guys mention a lot on this call so far is submarkets. And I think that's actually one thing we haven't touched on a whole lot on the show. You mentioned Boise being on fire. What are some other places across the U.S. right now that are starting to pick up steam and kind of, I've heard the phrase like the next Austin. Where else are you guys looking?
Well, Michael knows this. Adam, I don't know how much you know about Huntsville, Alabama. Huntsville is
Rocket City.
Yeah, Rocket City, baby. This is where NASA was established. And when Matt told me about Huntsville, I wanted to check Matt's temperature, and this was a couple of years ago. But think about it. I mean, Matt worked at Facebook. When Facebook announced that they were going to build a data center in Huntsville, it sets off a signal, right? And then you start to understand what's happening there, and you have Google doing the same thing. You have Toyota Mazda building an advanced auto manufacturing plant there, same as Mercedes-Benz. FBI announced that they're going to build their quote unquote HQ2 in Huntsville, Alabama. We were traveling to Nashville, chasing value add apartments, in which we never bought anything there. We just didn't compete very well as a buyer. And Huntsville sits maybe 90 minutes south of Nashville. We also are sensitive to what's happening along the coast in the South and in the Gulf. And we don't want to be on a coastal city. And Huntsville sits inland far enough. So it's checking all these boxes, and we decided to take a trip down there. And when you talk to the people that have lived there for a long time, you can feel the energy that they're experiencing on a daily basis of how the city is actually transforming. in their daily lives. And so we started investing there 2 years ago, and we will continue to invest in that town because it feels like it's just getting started. All of those companies that I had mentioned have not opened their facilities yet. And so those jobs are coming online in a small MSA. And this story is, this is a very similar story to Boise. We're bullish on these markets throughout the Midwest that have just pro-business mentalities. And Milwaukee is a great example in Wisconsin of a city that we think is going to thrive over some time just because of their policies of trying to bring businesses to their town.
I can tell you, as somebody who's invested in Milwaukee and lives in Illinois, the people that live in Illinois and manufacturing, warehousing, and everything else is moving north across the state line into Racine, Milwaukee, that area, and moving east towards Indiana, because both are lower cost, lower taxes, and much easier to do business in. So and you had also mentioned in the past, I know you and Matt really like Indianapolis, which is a great town too.
Yep, we own an industrial property in Indianapolis, actually a really nice property. We don't have any secret list, Adam. We look at the same things that you guys do and any other investor would. We love the U.S. growth markets. We think Boise and Huntsville are two of those. There's many others. Part of our profile is we're not going to go in and compete in a bidding war situation on pretty much any deal. It's just not in our nature. That's not what we do. Markets that are extremely hot, like a Nashville or Raleigh, they're just markets that they're interesting to us. We will be opportunistic. We're not going to go spend a ton of time there because we're not confident that deals, are going to come to us in the way that we need them to. And then on industrial deals, we kind of talked about some of the factors that insulate them. And you don't need, the interesting thing, we always think about growth markets, growth potential, incomes rising, populations rising, jobs being created. But for industrial properties, you don't necessarily need the market to be doing that. You need a strong market. We like to have very low vacancy. The population doesn't necessarily need to be growing. Incomes don't necessarily need to be rising. The business, in fact, as the tenant, doesn't even necessarily need to be growing. We want it to. But if 1% of your annual revenue is rent and your business is doing well and it's been around for 30 years and it's not growing, to me, that's not necessarily a deal breaker. You still have a lot of room for your business to be cut in half or cut in, significantly more than in half, and you're still probably going to be pretty comfortable paying rent. So we look at a whole host of factors. We don't have a secret list, unfortunately, of hotspots.
Cool. That still helps. It helps a ton, though. Thank you for sharing that. And it's time to wind this down. I know we could probably keep going for another 3 hours if we wanted to. Michael, any closing remarks before we end it here?
I don't have anything other than I've really, since I've met Dan and Matt and the Driven Cap team, love the way they operate. And that's why we wanted them on to talk about, because they're doing things that we aren't doing and can explain them a lot better. Just really want to thank you guys for coming on and giving us a little bit about your history and the education. Really, really, really appreciate the education.
And Matt and Dan, if you guys could just give us, your closing remarks as well, and then the best way for anyone listening to follow up and get in touch with you guys.
Appreciate the chance to speak with both of you. As always, hopefully we'll get together in person sometime soon. Our website is drivencap.com, short for Driven Capital. Matt at DrivenCap, Dan at drivencap.com. Yeah, please look forward to chatting with anyone that's interested in what we're doing. And thank you guys again for the opportunity. I can't believe I possibly spoke more words than Dan.
I think you guys were pretty balanced. It's like your balanced fund philosophy. So.
Well, we'll have to talk about that when we get off the show.
And Dan, could you spell Driven Cap for us just to make sure that
RIVENCAP.com. So come check us out. But Michael, Adam, thanks guys. This is as you said, we could probably sit here till happy hour today. So appreciate you having us on.
Absolutely. Thank you guys. All right, everyone. Thank you for joining us here on Nothing But Net, the podcast for triple net commercial real estate investing. I'm your host, Adam Carswell, joined by our co-host, Michael Flight. Thank you for tuning in, and we will catch you in the next episode. Thank you once again for joining us here on Nothing But Net, the podcast for triple net commercial real estate investing. If you enjoyed what you heard today, one last friendly reminder to like, share, subscribe, or leave a review for us. It really helps a ton with the show's visibility. For the Nothing But Net team, I'm Adam Carswell. Take care.
Nothing but net.
The Nothing But Net podcast is not intended to provide legal, tax counsel, or accounting advice. Adam Carswell, Michael Flight, Concordia Realty Corporation, Liberty Real Estate Fund LLC, and their affiliates do not provide tax, legal, or accounting advice or the worthiness and promotion of any particular investment. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction or undertaking. We highly encourage individuals and investors to seek the counsel of a qualified attorney as well as seek the counsel of a tax professional or certified public accountant to determine if there are any potential tax liabilities or consequences as a result of anything contained herein. All listeners of this podcast or video should understand that there are no guarantees of any success, outcome, or profitability of any transaction or undertaking, expressed or implied, and will not be liable for any financial or other losses or damages incurred as a result of any undertaking. Go to nothingbutnet.us for a complete set of disclosures. Thank you.